day, everyone. You're welcome to this week's Business and Investment Tips program, a production of Christ Church Radio with Ayodeji Ebo, an investment professional. This week, the focus is on a review of global and domestic developments, rising inflation and interest rates. In light of rising inflation across the world, the central banks of developed countries have all been pressing for sharpest interest rate hikes in decades. The U.S. Federal Reserve, Bank of England, and European Central Bank are taking dramatic actions to calm inflationary pressures running at the fastest rates since 1980s. As a result of this, the U.S. Federal Reserve, which is the central bank of U.S. responsible for setting the key interest rate, announced its biggest rate hike in 28 years of 0.75% to a target range of 1.50 to 1.75%. Similarly, the Bank of England raised its benchmark interest rates to 0.25% by 0.25% to 1.25%, while the European Central Bank (ECB) intends to raise its key interest rate by 0.25% in July and by 0.50% at its next three meetings of the year. Generally, interest rates are the central bank's main tool to combat inflation, since they reduce consumer spending by encouraging people to save more. Curbing consumer spending, on the other hand, risks slowing economic growth and, to a greater extent, triggering a recession. Due to this risk, central banks have significantly cut their outlook for economic growth in 2022 and 2023. In a similar narrative, the CBN's MPC recently raised the MPR by 1.5% to 13% in a bid to control the spiraling inflation rates. Link attached. While banks are starting to offer higher interest rates on savings accounts, it is important to know that these rates still offer lower yields compared to other investment vehicles in the fixed income space. You should know that the real worth of savings, which is the things that it can buy, will continue to decline over time if interest rates remain well below the present inflation rates. The most recent Treasury bill sale gives us an indication of the direction of interest rates. Demand was robust at last week's primary market auction, PMA, as the amount offered was small relative to other auctions. Hence, stop rates dipped lower than its last auction 2 weeks ago. With this, stop rates on the 91-day, the 182-day, and the 364-day bills dropped by 1 basis point, 5 basis points, and 37 basis points to 2.49%, 3.79%, and 6.07% respectively, as the allotments fell in proportion to subscription levels, putting the bid to cover ratio to 5.12 times. This suggests that the government is attempting to limit its borrowing costs in the face of higher interest rates. So how do investors position? 1. Commercial papers. The falling interest rates gives relief to corporates to raise short-term capital through commercial papers. This presents a good opportunity for investors to earn higher returns than T-bills. We have observed a flurry of CPs issuance in the past week, and we expect this to continue. However, investors should be mindful of the credit rating of the company before investing. 2. Fixed income mutual funds. Fixed income mutual funds is expected to deliver impressive return due to the higher interest rates in CPs and bank placements. Mutual funds help you to diversify your portfolio. Fund managers invest across several CPs rather than investing all the funds in one company's CP. Mutual funds also offer you the opportunity to take out your investment at any time compared to CPs. 3. Investment in Eurobonds and dollar mutual funds. Due to the higher interest rates in the developed climes, yields on sub-Saharan African Eurobonds have increased significantly, ranging from 10 to 22% yield. This presents good investment opportunities for investors with the capacity to invest up to $100,000 to $200,000 in Eurobonds. However, dollar mutual funds have a lower entry level of $100 to $1,000 depending on the firm, and are easier to redeem your investments. 4. Investment in foreign stocks. In the period of higher interest rates, prices of stocks are cheaper and present good entry opportunities for long-term investors. You can buy in trenches, dollar cost averaging, as the stock market has proven to always surpass its previous all-time high when the economy rebounds. You can also invest in exchange-traded funds to diversify your risks. See the link to know more about investment opportunities in ETFs. 5. Investment in federal government savings bonds. The federal government savings bonds is one of the safest forms of investment in Nigeria and offers higher interest rates than T-bills. The minimum investment is 5,000 and is issued monthly. You can invest through your stockbroker. The suggested investment opportunities allow you to reduce the impact of the rising inflation rates and depreciating naira on your savings. Leaving idle funds in your savings and domiciliary bank accounts will leave you worse off. Thank you for listening. Please join us same time next week for another exciting and insightful session. For questions, comments, and feedback, kindly forward to info@getfinanceandinvestmenttips.com or send an SMS to 070-8246-3747. Stay blessed.